Good morning and happy Friday. Welcome to Stock Market Today for November 22nd, 2019. I am your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. Find me on Twitter. I'm at Dan_Russo_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where you can get daily stock ideas for you to consider in your inbox every trading day before the market opens. And before we get into it, just a quick programming note. This show will not air next Friday, the day after Thanksgiving. So just something to keep in mind. Let's get into it now. Major U.S. equity indices were lower in Thursday's trading, but closed off the worst levels of the day. Energy, comm services, and healthcare outperformed, while REITs and staples lagged. Treasuries were weaker across the curve. Dollar was stronger on the major crosses. Gold finished down 70 basis points. WTI crude was up 2.8%. Closed near the highs of the day. As we get to the desk this morning, S&P futures are slightly higher, up about 20 basis points in Friday morning trading, but U.S. equities are still on track to potentially break a 6-week winning streak. Asia was mostly higher overnight, but China lagged. European equities were stronger this morning. Treasuries are stronger across the curve. The dollar is flat against the yen and the euro. Gold is up 60 basis points, and WTI crude down 20 basis points to get us rolling on a Friday morning. Let's look at the S&P 500 here. What I see is a consolidation below all-time highs. We've kind of pulled back over the course of the past 3 days or so. We're still holding above the breakout level. Key support to the bigger picture trend is the 200-day moving average at about 29.15. In the near term, support is in that 30.30 to 30.50 range that we've been highlighting. Got it here with the red lines on the chart. And then below that, 29.50. Those are those gaps that opened in both directions, really, during the consolidation that took place between July before ultimately breaking out in October. RSI is exiting overbought levels. Here's that 14-period RSI we've been talking about. It got overbought. That was a sign of momentum. And now we're rolling out of that overbought condition. Ideally, what we'd love to see, right? This is when we start to talk about the setups and the if-then scenarios. And this way you're not surprised when something happens. You're ready to take action. What we are looking for ideally, should this consolidation / slight pullback continue to unfold, is you would be looking for this near-term support level to hold while the RSI stays in bullish ranges. So if we get a pullback to support with the RSI holding near 40 or 50, that would be a sign that this is merely just a pause within the context of a bigger uptrend and likely to resolve to the upside. If the RSI heads lower, breaks below the lower bound of bullish ranges, then you have to start increasing the odds that these support levels will give way. For now, we're continuing to stay the course, but that's the game plan, and that's how I'm thinking about the market here as we go forward. Chaikin money flow is still bullish, so that kind of increases the odds that support will hold. Let's hit our market in a minute now. What are we writing about in the note today to Chaikin Analytics clients? Well, we've hit on the SPY already, consolidating just below record levels. Semis are nearly oversold and holding the relative breakout level. Group came under pressure yesterday. We'll talk about that a little later, but we're going to look at a few semi charts today in the show. We have a higher low for small caps on a relative basis, and I think that could be important. Key themes that we look at to measure risk sentiment in the market are slightly mixed this week, but still skewed towards risk seeking, and futures do point, as I said, to a higher open here today. Let's take a look at the power bars now. The market coming in a little bit, saw a slight deterioration yesterday. The Dow down 17 basis points, 4 bulls to 7 bears there. S&P 500 down a like amount, 124 bulls to 91 bears for the power bar ratio on the S&P 500. NASDAQ, 22 basis points to the downside, 31.16, so dropping below 2-to-1. Small caps were an underperformer on the day, 644 to 321, still better than 2-to-1. Bulls to bears for the small caps. Bonds down tick, sending yields higher. Energy was the big name, big sector on the day, up 1.64% with that 2.8% rally in crude oil. But as we've been saying, fundamentals there still remain weak. 17 bearish stocks for 3 bullish stocks. According to the Chaikin Power Bar, small cap stocks and large cap stocks are bullish. Major markets across the board, however, are mixed. Let's hit our stock of the day now. And before we go any further, I'm going to say kudos to Mark Chaikin, who highlighted this stock about a month ago in his weekly note to our clients as a bullish idea, and the stock has performed phenomenally well since he made that call. But CVS Health, 74.94, up 3 basis points yesterday, has a very bullish Chaikin Power Gauge rating due to very attractive financial metrics, very strong earnings performance, strong price volume activity, and positive expert activity. 20 factors give us this very bullish rating. Strong trend, strong industry group. The healthcare providers has been a strong group of late. What do we have here? We have the market and the model in agreement. Been bullish since August, started to outperform shortly after that time frame, and continues to outperform the market with some good relative intensity. Chaikin money flow bullish, above the trend line, nice gap higher after earnings. Really, my only issue with CVS today is this just the overbought nature of the stock. Right, you want to look for maybe to work off this overbought condition. We've had a nice run here. Stock was in a clear downtrend, nice rounding bottom and moving higher. What I'd love to see is a consolidation that holds above $70, works off this overbought condition, and sets up a better entry on the long side. But once again, just shout out to Mark Chaikin, who had a great call here for our clients in his weekly market note about a month ago. Keep an eye on CVS here. It's still a good-looking stock, right? Very bullish and outperforming the market with bullish money flow, kind of our definition of a classic bull. Just want to try to buy them right. And right now, the stock is overbought. Let's hit our sector tracker now, right? Moves like you've seen in CVS and some of the other bigger names in the space have helped healthcare stay near the top of the list of the sector movers over the last 5 days, up 2.6%. Over the last 5 days. Comms have done well. Energy, nice little rebound of late with the price of crude oil, but we've kind of hit that one pretty hard with the fact that the fundamentals still remain unattractive. Utilities, tech, and staples are middle of the road. Down over the last 5 days. Financials, REITs, industrials, discretionary coming under some pressure with some mixed bag out of retail earnings this week, and materials are at the bottom of the list. So some of the rotation playing out that we've been talking about, it doesn't happen in a straight line, right? We've had this rotation from defensive to cyclicals, and now we're seeing a bit of a pause there. We want to try to start to dig in now and get a sense for if the trend is likely to continue. The growth to value shift still appears to be ongoing. But again, these things are not going to happen in a straight line. There's going to be backing and filling and some counter trend moves within the prevailing trends. Now, our industry in focus today is going to get a lot of attention today. Semiconductor services, which has been a big outperformer over the past 6 months, leading the S&P 500 by 13.69%. Power bar ratio is slightly weak. This is for the XRT. 10 bullish stocks or 11 bearish stocks, currently ranked number 14 of 21 subsectors, having moved down 2 slots over the past week as it's come under a bit of pressure. The names you want to avoid in Semiland are Cree, CREE, very bearish rating, Semtech, SMTC, with a very bearish rating, and Texas Instruments with a very bearish Chaikin Power Gauge rating. But let's take a look at the chart here. Here's XSD. I usually use SMH in my notes, but we're going to take a look at XSD here because this is what's highlighting in that email that I mentioned at the top of every show. XSD, the semiconductor ETF, has a bullish Chaikin Power Gauge ETF rating and is in a strong trend above a rising long-term trend line. Been outperforming the market since June with that bullish rating, and Chaikin money flow is still bullish even as the fund pulls back here. Now, we've entered an oversold condition on that pullback, and we have some solid price-based support. Right? What do we have here? We have, you can kind of start to call this an ascending triangle with a low at 85 and a high at 95. So a 10-point range on the breakout. Targets 105 for XSD for you classical pattern and classical chart folks out there. What I see is an oversold fund that's outperforming the market with a bullish rating and bullish money flow. Importantly for the broader market is this relative strength, and we're going to take a look at that a little bit later in the show. Let's hit what's trending now. Yesterday's S&P 500 movers and shakers, our gainers and losers. L Brands, bearish stock. It's been a complete mess, no doubt about it, but their earnings were better than feared yesterday, and that led to a 10% relief rally in the stock. Schwab up 7% on a potential tie-up with TD Ameritrade. That was the big news in M&A yesterday in the marketplace. Devon Energy, no real news there, likely trading higher with the energy complex yesterday. Noble caught a buy rating at MKM Partners. Still a very bearish rating at Chaikin Analytics, but the buy rating sent the stock higher by 3.5%. And Copart, no real news. Stock did hit a 52-week high yesterday. Loser side of the board, well, the potential tie-up between Schwab and Ameritrade puts E-Trade under pressure, down 9% on the day. And now CLAC, AMAT, and LAM, KLAC, AMAT, and LRCX, all downgraded at UBS yesterday, going to a sell rating, mostly citing valuation from what I've been able to read. And that's really what pressured the semiconductor space yesterday, was that big shift in view from UBS. CAG down 4.3% on the day yesterday. Didn't see any real news to drive trading in that stock. But let's dig in, because let's talk about those semiconductors. Here's the chart that you know and love. You should know it by heart by now. SMH relative to the broader market broke through 2-year resistance, continued to move higher, and now we're getting a bit of a consolidation. Perfectly normal to see a consolidation after a strong move. The ratio still is above the rising 200-day moving average. And why do we care? Because when this line is rising, the market tends to continue to go higher as well. And it does tend to lead at turns, right? Bottomed out before the market, topped out ahead of the market. But what's interesting to me here is that this pullback, the RSI has stayed in bullish ranges. And notice the shift. This is a good example of the shift that we talk about that takes place with RSI, depending on the trend. In an uptrend, you would expect to see the RSI holding above the 40-50 range and never really becoming oversold. And that's what we're seeing here. Contrast that with what happened when this ratio is in a strong downtrend, right? Routinely becoming oversold, never becoming overbought. So that's the shift that takes place in the RSI, and you can use that to lend a confirmation to what you're seeing from a trend perspective. It's also important to understand the personality of your indicators, because if you're using RSI as an indicator and a stock or an ETF or the market in general is in a strong uptrend, if you're going to use RSI and you're going to say, well, I'm going to wait for that oversold condition before I get in, well, you may never see that 30 level, because in a strong uptrend, the RSI really doesn't get much below the 40-50 level. So it's important to understand the personalities and the characteristics of the indicators that you're using. SMH is still in a steady uptrend on an absolute basis. So a little bit of a pullback here for the semiconductors in the near term, but they're still bullish at Chaikin Analytics, and the trends still look good on both an absolute and a relative basis. Now, let's look at the small caps, right? Because we haven't been shy in our view on small caps. You've heard us say numerous times that we favor large caps over small caps. And really what we've been waiting for is a shift in this trend. This is the IWM relative to the SPY. Remember, on Fridays, we look at key themes and relationships. And in the marketplace, this certainly is one of the key relationships that we want to pay attention to. Steady downtrend, breaks the 200-day moving average, and just continues to head lower. Right, with the trend still very much in place since the June 2018 highs. But what's interesting to me is that we got a low, a test of the low, and now a higher low on a relative basis. It's something to pay attention to, right? A couple weeks ago, we started talking about the fact that momentum to the downside looked like it was waning, right? Look at the RSI not becoming oversold and putting in a series of higher lows. Right. So we started to say that downside momentum looked like it was waning. Now we get a higher low in this relationship. This could be an interesting development as it relates to the small caps and large caps. And when you're looking for individual ideas, for a long time we thought it made sense to favor large caps. And while that still largely is the case, we want to start paying attention to this relationship, because if we start to make higher lows, break above the 200-day moving average, we could see a shift for small caps relative to large caps that would warrant maybe paying attention to some of the small cap stocks within the marketplace. Remember earlier this week, we looked at small cap tech starting to break out and actually outperform the market. Not there for broader small cap just yet, but something we're paying attention to. And on an absolute basis, really the line in the sand for a breakout is the $160 level for the IWM. That is the level to watch, and we'd love to see a breakout there. For nothing else, what it says about breadth. And this is the one chart here in my themes that's bothering me. It's discretionary relative to staples, can't get a breakout. So even with a risk on type environment that we had seen over the past few weeks, can't get a break through the 200-day moving average. We'd love to see discretionary join the party and start to outperform. Now, we are testing key support on a relative basis, and the RSI has made a series of higher lows. So if discretionary is going to start to outperform staples in a meaningful way, this would be the spot. That's it for the week, folks. Have a great weekend. I'll see you on Monday.